So you need to know the rules of the game. You need to know what strategy to use at what time, and that should be the main mantra for any trader, whether it is a new trader or a seasoned trader.
On this episode of Early Bird, Sid Bhattacharjee, the co-founder and chief strategist for Sapphire Capital. Sid joins the podcast today to talk about the reward-risk ratio, what it means for investors in 2022, and the advantages and disadvantages to this strategy. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you, you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, Sid, welcome to the Early Bird podcast. How are you doing today?
I'm doing very well, Stephen. Good to be able to talk to you.
Good to be talking to you too. Definitely, it's wonderful to have you here. I can't wait till we start a conversation about the reward-risk ratio. Before that, Sid, let's tell the audience a little bit about yourself. What should the audience know about you in like 30 seconds or so? What's a good Reader's Digest biography about you, Sid?
Thank you. Sure, I'll keep it less than 30 seconds. Sid Bhattacharjee is my name. I'm the chief strategist and co-founder of Sapphire Capitals. About 20 years veteran in trading stocks and ETFs. And I have over the years built several trading strategies and so on and so forth for our internal use. Some of those are commercially available as well. Personally, I've got an engineering degree and an MBA in finance and corporate finance and merger and acquisitions. I've worked in multiple multinational organizations around the world, but currently my time is mostly focused on being the strategist in our proprietary asset management firm that we run. So that's briefly about me.
Nice, Sid. It's really great to have you here. We're talking about the reward-risk ratio, what it means for investors this year. Real quick, what's the definition for the reward-risk ratio? How would you explain it?
In very simple terms, reward-risk ratio is as it is, the word itself, the words themselves. For example, what reward would you be expecting for a certain size of the risk that you're willing to take? For example, you might say that I will risk $1 for a reward of $5. So that makes your reward-risk ratio 5:1. It's as simple as that. But that's a very, very critical factor if you're trading in financial markets, irrespective of whatever you trade, stock, ETF, Forex, it doesn't matter. That's the key criteria that one has to use or keep in mind before making any trading decision.
Got it. It seems like it's an important aspect of trading. Is this a strategy that you use and that you recommend for your clients, I suppose?
Absolutely. I'll tell you a little bit of a background as to why a reward-risk ratio is important. A couple of reasons. One, financial markets are speculative in nature. So there is absolutely no certainty that certain events are going to happen or may not happen. So that's one thing. So what you have in your hand as a trader is something called a positive expectancy. So you take multiple trades. Some of them will go in your favor. Some will not go in your favor, as you could expect, because there is no certainty in any respect, because the financial markets are as such. So what you have in your favor is something called a positive expectancy. And I mean, I can go into the definition of positive expectancy, but let's check the conversation on reward and risk ratio. So while talking about positive expectancy, one criteria in that is something called reward risk ratio, apart from the other criteria being probability of the win rate. Now, I do not want to complicate this discussion. Just keep it simple in reward risk ratio. In that, every time you make a trading decision, you can make an assessment that the trade I'm going to take, is it giving me a reward at least 2:1, 3:1, better than 1:1 for me to be able to take that risk. So that's something I always have. This has been the principle for every trade that we do in our proprietary fund management and the clients and then the people that we deal with. This is a criteria that I definitely ask them to keep in mind. Of course, apart from that, as I mentioned, win rate or the probability, that's the other criteria. That could be subject to discussion another day. But this becomes the core principle before making any trading decision.
Got it. It seems like it's a big part of your strategy. What are the advantages of the reward risk ratio for investors?
You know what? I wish I could show you a small table. In the table, you could have seen that how the reward risk ratio and the win rate they play out in your trading decisions, and what sort of results can you expect, or what's in a longer run. I just wanted to make just one quick reference to the table, or rather one row of the table, in which I would like to bring it to the attention of the traders or listeners, or your listeners, basically.
Sure.
Is that if you have a 50% win rate in your trades, just 50%, so it's like tossing a coin, okay, 50%. And you have a risk-reward ratio of 1:1, that means you are getting a reward of $1 for every $1 you risk, then your trade will always become break-even. That means you'll neither make profit, you'll make a loss. So it will be always a break-even. That's, and of course, I'm assuming that no commission costs are involved here. The commission will have a play here, but I'm just, for the purpose of the simplicity, I'm removing the commission cost. So if you have a 50% win rate of your trades and 1:1 risk-reward ratio, then you make a break-even. Now, you as a trader want to do better than break-even. How do you do break-even? So there are 2 ways or 3 ways you can do it. Either your win rate will have to be higher. You must be winning more than 50% of the trades, or your reward risk ratio should be more than 1:1, maybe 2:1, 1.5:1, 3:1, 10:1, or both. You could achieve effectively both by judiciously selecting certain stocks and ETFs that delivers you both a higher win rate and a higher reward risk ratio. And that way, you will have a definite positive expectancy, and you'll have far superior result than just a break-even.
Got it. And so would it be fair to say that one of the benefits of the reward risk ratio is that it helps with risk management as an investor?
Absolutely. So that's the second criteria. When you say risk management, that has been the mantra in our trading all the time. The trader has to, of course, this is a bigger discussion, Stephen, but I'm very happy that you raised this particular point. Risk management has to be the absolute key criteria. The protection of your capital, that's the main doctrine in anything you do in financial markets. And number 2 is that, how do you ensure that by selecting trades with a higher reward risk ratio, you're effectively managing your risk, that you have made a decision that I won't be risking more than $1 for every trade, or $10 or $100, depending on your size of the capital. So you have made a decision that every time you risk $1, 10, 100,000, 10,000, or $1 million, you have certain reward in your mind. That's the fundamental concept that a trader has to be mindful of before making any trading decision. So yes, that's the risk management in one way, that you have already made a decision that I'm not going to risk more than certain dollar for that particular trade.
And I certainly see the benefit of using the reward risk ratio as an investor, and I see where the advantages lie. What about some of the disadvantages? What are some of the drawbacks of the reward risk ratio?
Well, good thought, Stephen. The disadvantage, I would say, there are traders I have come across in my 20 years of trading, and I have come across people who would like to be rich overnight. I mean, it's kind of they consider trading in financial markets sort of get rich quick sort of a system. And this is where the problem is. Reward risk ratio brings in a lot of discipline in your trading. You are thoughtful. You already know what is going to happen. If risk plays out, then you walk out of your position, or if risk doesn't play out, then you get the benefit of the reward. So that's a discipline. That's a discipline a lot of people do not like. So I would say that's a massive disadvantage for the people who want to be in a get rich quick system.
Good point. When we return, we'll hear from Sid about how the reward risk ratio factors for investors in 2022. But first, let me tell you where you can become a more informed investor through Early Bird, a free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, Sid, today we're talking about the reward risk ratio. I want to take a step back a little bit real quick. 2022, we're not done yet with the year. We're almost done. How would you describe the market in 2022 so far for traders?
That's a very good point, Stephen. I'm happy that you raised this particular point. We have seen from the beginning, not quite in the beginning, probably in the second quarter of this year, the volatility in the market has all of a sudden has spiked up a bit. And this is because of various news coming from various central banks of the world, be it IMF, be it the Central Bank of America or Central Bank of Australia. So the volatility is up there. The interest rate has gone up because of the inflation, the fear of inflation rather, not the inflation itself. To some extent, it's also the fear, and some extent, actual inflation has gone up. So everything put together has kind of made the market a bit difficult for some traders, even for the seasoned ones. So the reward risk ratio assumes far higher importance now because the market is not kind of a steady state. It's a very unsteady, and probably it will remain so for the remaining part of the year and perhaps even 2023. So I believe specific to the market condition that we are right now worldwide, I have specific interest in stocks in Australia, as in Europe and US, and I have seen this sudden surge of volatility in the marketplace. That's why the protection of your capital is paramount importance, and making sure that your trading decisions are, as bulletproof as you could make, and hence the reward risk ratio is perhaps more important than ever.
Good point you bring up. It's a very tough market this year. A lot of traders, a lot of investors have lost money in the stock market for sure this year. How would this strategy, the reward risk ratio, how would it have made a difference this year? Or is it possible that the market's so difficult that this strategy would have not had any real impact whatsoever on a trader and how they performed?
No, I mean, the relevance of reward risk ratio is never going to subside. It's going to be there. It's all important in whatever market condition it is. It is more relevant now, and perhaps in 2023. I don't think it will have any less relevance one or the other. For this particular year and the volatility and all these issues that we are talking about right now, my view is, as it was always, that its reward risk ratio is one of the components of your decision making. The other component is the probability, which is not the subject of discussion today, but probability is where you pick certain stocks that has got a higher probability of making large bullish or bearish move, and use that criteria along with the reward risk ratio to make it as bulletproof as you can. So to your point, Stephen, the reward risk ratio relevance of that will never subside, but that probably is one side of the puzzle. You probably need probability as another key element in your decision making process.
So the strategy you're saying in a tough year like this, you have the reward risk ratio, but there's the issue of probability that sort of weighs in, and so that has nothing to do with the reward risk ratio. That's what you're saying, right?
No, I didn't say quite that. What I was saying is this two, the interplay of these two will make your strategy far superior. It's not reward risk. They're interdependent. Remember, I was trying to focus on reward risk ratio as a general strategy. But if you in a tougher market where we are right now, you need to take into account probability as another criteria. So these two criteria together is what you'll be looking forward to.
Got it.
Makes sense?
Yeah, it totally makes sense. A lot of investors these past few years are used to walking away from the market with some pretty high returns, as you can imagine. This year, it seems like a lot of investors are probably going to lose money. Some might break even. Is a strategy such as the reward risk ratio one of those factors that could, change that? So maybe you'd walk away in a tough market, more profitable than the year before, or at least break even?
So there are two, Stephen, if I understood you correctly, I just want to make 2 points in relation to your question. I would like to differentiate between a trader and the long-term investor. Our focus in Sapphire Capitals has always been trading in a time horizon of between a month or a couple of months, or maybe three to 4 months at the max. So we are looking at it trading. So we're looking at opportunities where there is a large bullish or bearish move in the marketplace of certain stocks, and that's the advantage you're going to take. So we are not a buy and hold kind of people. Okay.
Got it.
So a lot of investors in the marketplace, they hold on to the stocks for probably 6 months, 1 year, maybe a couple of years. So that's the investor category, and we are talking about trading categories where I'm very keen to find out if certain stock, let's say Amazon or whatever stock you can talk about, is it going to make a big bullish move in next 3 months? If yes, I'm very interested and I want to find out.
Got it.
So that's the one aspect of it. The other point I was trying to talk about is basically is that these two components interplay, and they're very important. And what I'm trying to say is that the focus will always remain, even if I know of a certain opportunity, let's say Amazon or Tesla or any stock that is going to make a bullish move, depending on various criteria that I found out using one of our trading applications. Now I'll see whether or not that particular opportunity will deliver me the reward risk ratio that I want. Am I getting 2:1, 3:1, 5:1? If it makes sense, we'll make the suitable trading decision. So the relevance of the strategy will always be there. It is far more important in the market condition that is now. The traders will have challenges depending on the volatility of the marketplace, but as long as the criteria you select trades with the correct reward risk ratio, depending on your risk appetite, you'll become successful on the other side. So that's bottom line of the strategy, Stephen. I hope I have answered your question.
Yeah, thank you so much for explaining, Sid. I really do appreciate it. Real quick, if you're an investor, you're a trader, and you want to get started with the reward risk ratio, what advice would you give them if you want to start using that strategy?
So depending on how do you pick a stock? For example, some people do price action, some people do various other strategies they use. They look at the naked chart, and they can do support and resistance. There are a plethora of strategies that people use. I think anybody in either brand new or even the seasoned ones, they use different kind of strategy. We in Sapphire Capitals, we have trading applications which use certain strategies there. So irrespective of whatever strategies you pick, these two things you must be able to make sure of. First, what is the probability of that bullish or bearish move to play out? And number two, if that plays out in your favor, what reward risk ratio would you be happy with, or what level of reward risk ratio you're comfortable with to be able to make this trader successful? Because everybody, as I just a few minutes ago I mentioned, that discipline doesn't exist in a lot of traders. That makes me feel very sad. In over 20 years, I've come across many people, many traders, and I do feel that their anticipation is or their expectation is very different from what the reality is. I mean, if you're disciplined, if you have a strategy, if you do have a log, and if you understand numbers, that's another important aspect I wanted to mention about you, is that you need to understand the basics of how the trade or your position in a marketplace plays out. I often give an example. I said, if you're going to play golf, you need to know what club you have to use and how the runs, your points are scored. And if you don't know that, and if you're all of a sudden you find yourself in the golf club, you are completely lost. So you need to know the rules of the game. You need to know what strategy to use at what time. And that should be the main mantra for any trader, whether it is a new trader or a seasoned trader. So these are the few basic principles that I believe, is a very key to successful trading.
Got it. Thank you so much for explaining it. The golf analogy makes perfect sense. Sid, thank you so much for coming on the Early Bird podcast and explaining what the reward risk ratio means for our listeners, all the traders and investors out there. Before we wrap up the show, just one final question, Sid, and it's the most important question for today's discussion. That question for you, Sid, is if there was one emoji out there that best describes you, what would that emoji be?
Thank you, Stephen. I didn't think about it, but I would say my emoji would be a smiling Buddha.
Mm-hmm. Why is that?
Because smiling means, irrespective of what happens in the marketplace, if you know, you exactly have a game plan, very clear picture in your mind that, yes, my decisions are based on this criteria, and I exactly know if it goes in my favor, what is going to play out. If it doesn't go in my favor, how it's going to play out. So I know the outcome of it well beforehand, or I have at least planned for it. So that's the reason I'm laughing. So I'm never sad. Market doesn't make me sad or unhappy because I know what the outcome would be based on my criteria. So that's the reason. Number two, Buddha, because I say my first name is the other name of Lord Buddha. And he's always a happy man. He has spread happiness around the world. So that's what I would think is probably best described that emoji.
Nice. That sounds wonderful. Thank you again to Sid Bhattacharjee for sharing your insights on the reward-risk ratio. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.